welcome to everybody, and a special welcome to our guests. I'm not going to take a great deal of time introducing them because I think they're in the brochure. But on my left, immediate left, is Bruce Kasman from J.P. Morgan, Mark Zandi from Moody's, and Steve Whiting from Citibank. They're each going to give us a fairly short view. I know economists can go on a bit, but I've asked them each to go on for about 10 minutes. I may then ask each of them a question or two, or the panel a question or two, and then we will open it up for the last 15 minutes or so to questions from the floor. So with that, Bruce, would you give us your views?
Okay, thank you, and thanks everybody for showing up and giving us the opportunity to speak to you. The thing I want to talk about is how we see the global economy playing out, what it's likely to deliver over the next 6 to 12 months, and perhaps just a couple of words on what it means, because I think performance over short periods of time are really interesting in terms of what they tell you about more of the medium-term and longer-term path. The bottom line from my perspective is that the global economy right now is in the midst of lifting. This lifting is, I think, quite significant because I think it's signaling that a 2-year period of subpar growth and what I've been calling an extended soft patch is over. And that's a really important positive that I think is taking hold here. Why is it happening? On one level, you can see credit conditions improving. You can see important fiscal drags fading. You can see monetary policy across the major central banks doing more, and I include obviously what the Fed told us yesterday alongside what we've seen from the Europeans and the Japanese. On another level, and I think it is an important level to get into, what we're seeing is broken policy frameworks being fixed. That's not a U.S. story per se. It's mostly a story about Europe and the problems in the policy framework set by governments and the ECB that intensified and turned the crisis of sovereign debt into something which was existential, and it didn't have to be. And I think the steps taken by governments and the ECB with the OMT program, the steps taken to move away from damaging pro-cyclical fiscal policy stances, the steps taken, I think, also more recently by the ECB to be a little more sensitive to growth, have all not only changed the growth picture in Europe, but has changed the trajectory in terms of how we think the nature of risk in the world. And I would complement that by saying Japan has moved away from what were failed policies and also dangerous policies in terms of the path that it was moving on. That doesn't mean that Japan is now a healthy place, but I think with BOJ policy turning reflationary, with the Abe administration turning its eyes towards structural reform and beginning next year fiscal consolidation, I think we feel Japan is on a much healthier track. So the combination of these things are not only lifting growth, but they're changing the nature of the way we see risk here. I'd emphasize growth still constrained here, and in that we can point to fiscal drags fading but not going away in the developed economies. But I would actually emphasize the emerging markets, which are in the process of unwinding a lot of excesses that have been built up over a long period of time in credit conditions in terms of tight labor markets that were really revealed and revealed in a way that created significant shifts in financial markets, which have worsened the situation in a lot of countries over this soft growth period. The second thing I want to highlight here is that if we're right about what's happening, there's a lot of rotations. There's a lot of things that are happening sectorally, regionally, which we should be expecting to see here and are going to be important. The first one, and the easiest one, because I think it's already started, is a global manufacturing sector, which has been beleaguered for most of this soft patch period, is right now set to pop. We've been averaging growth in manufacturing of less than 2% for the last 18 months on an annualized basis. I think for the next 6 months, we're going to be up to 5%. That's a big swing, and it's going to be, I think, pronounced both in terms of the output data, but I think it's also going to spill to some degree into some of the commodities that are very connected to manufacturing growth. The second thing, perhaps a little more modest but important, is we've had a nice run on the consumer, helped in large part by very low inflation. Oil prices are up. The benefits of that low inflation are fading. There's going to be a rotation towards slower consumer, but we think it's going to be offset by a move away from a business sector that has been extremely cautious with with basically CapEx globally having stalled over the last year. And then I want to just emphasize the regional story, and that comes back to a point I made a minute ago, which I think is Europe is at the center of the world. Europe's swing from a -1% economy to what we think is going to be a +1% economy has huge implications in terms of the global business cycle. It's really the call that I think is most important and the one that matters the most, also because our models tell us that as a region, Europe is much more closely connected to the rest of the world than China is, than the US is, than Japan is. So if Europe is swinging in this way, it's got broad and powerful repercussions across the rest of the world. Finally, what I want to talk about is what this means. And I want to emphasize that growth is a step on a path. It's not the end point. I'll just recall that in 2009, when we were all worried and downbeat about the US, we saw the US surprisingly pop out of recession in the spring of 2009. A year and a half later, the same people who thought the world were ending were then saying, boy, this is a disappointing expansion. And I think this is the nature of the beast we're going to have. I think we're going to get growth, but the healing process that needs to take place is probably going to be incomplete at best. And I think on that front, what we really need to focus on is the ability of growth in the developed economies in the G4, in the US, Western Europe, and Japan to generate better supply side conditions, get US workers back in the labor force, get capital spending working in a way that we improve productivity growth. In Europe, to get the growth to move in a way that stimulates better institutional reforms, and in Japan to complement growth with the structural changes, the fiscal consolidations that's needed. On that front, and obviously I'll go way over my time if I went into this, I think the good news is I think inflation will stay low and will provide a backdrop for central banks to continue to be favorable in terms of not having to tighten policy. But I think the news on the ground is relatively sobering with regard to the supply side. And the last thing I'll just say is in EM economies, you are going to get benefits of a manufacturing sector lift. You are going to get benefits of Europe picking up. It's going to be uneven, and I think the call in emerging markets is to differentiate those countries that are linked to the things that are improving in the world. But the process of unwinding excesses in credit conditions, unwinding excesses in labor markets, of getting back to doing the structural things that to some degree were delayed as a result of the very strong growth we've had in the last 5 to 7 years, those are going to be difficult ones, and ones which I think are going to be hard right now to be optimistic in terms of looking at. So to end this, I'd say I'm optimistic on growth. I'm a believer we've got room to grow with low inflation. I think a lot of good things have happened in the world, but this is just a step on a path where there's still a lot of challenges, which it's hard at this point, I think, to get real optimistic about some of the broader things that need to happen here to restore full health in the global economy.
Thank you very much, Bruce. And now, Mark, Chief Economist at Moody's, why don't you give us some of your views?
Will do. Thank you, Archie. Thank you, Noel, and the Foreign Policy Association for the opportunity to be here today. Bruce, you sounded optimistic. I'm enthusiastic about the U.S. economy. Just to give you a number, GDP, that's been growing about 2%. That's what we've been growing for most of the recovery. The recovery is about 4 years old. Give or take, we're growing 2% now. For the year, we'll come in around 2%. Next year, I expect closer to 3% growth and 4% growth in 2015. The unemployment rate is 7.3%. The full unemployment rate is somewhere between 5.5% and 6%. And I think we get there by the second half of 2016. To be precise, November 3rd, 2 p.m. Eastern Time, about when everyone's going to the polls for the next president, voting for the next president. Why? Let me give you 3 reasons. First, fiscal policy is, the fiscal policy drag will fade. So if you tote up the impact of all the government spending cuts, including the sequester, which is obviously having a huge impact on the defense sector, and the tax increases, it's about 1.5 percentage points of GDP this calendar year, 2013. So what that means is If fiscal policy was simply neutral with respect to the economy, zero, had no impact, the economy would be growing about 3.5%. We're growing 2. If fiscal policy was zero, we'd be growing 3.5%, which isn't too bad, pretty solid growth. Under current law, if there's no substantive change in policy, and I don't think that there will be for the foreseeable future, the fiscal drag will fade. It'll be about half of what it is this year, next year, so 0.7, 0.8 percentage points. In 2015, it'll be 2.3 percentage points. In 2016, it'll be gone, no drag. So that huge negative on economic growth in the near term will fade away going forward. In fact, the apex of the drag is literally right now in Q3 of 2013. The threat to this point of optimism, obviously, is Washington. They could screw things up. They've got a challenge immediately dead ahead of them, and that is they've got to pass a budget to fund the government. The government has no money at the end of this month, a couple weeks, so they've got to do that. And then they have to raise the debt ceiling again. My baseline optimistic perspective is that they'll sign on the dotted line just in time, only because if they don't, it's going to be cataclysmic. Shutting the government down for a few days won't be too big a deal, but a few weeks, that'd be a huge deal, and breaching the debt limit that's opening an economic Pandora's box. There's no way to put that back in. So given how dark that scenario is, I just can't imagine them not coming to terms. But this will sound a little bit mind-numbing. The fact that no one's scared or screaming or yelling right now makes me actually more nervous, because somebody needs to be screaming that this is going to be a real problem if they don't sign on the dotted line, because no one's screaming. They, in fact, may not sign on the dotted line in time. So that's clearly a threat to my optimism. Reason number 2 for optimism, housing. The housing market is coming back. Obviously, that was ground zero for our economic problems. It turned about a year and a half ago. Since then, substantive improvement in home sales, housing construction, and house prices, all very good news. And prospects are very good. And this is where we're going to get a lot of economic juice and a lot of jobs. I'll just give you another set of numbers. Current construction is running around 900,000 units. That's single-family, multifamily units, 900,000 per annum. Throw in manufactured housing, mobile homes, we're at 950K. In a normal economy, not even just a good one, just a plain old vanilla normal economy, we should be producing 1.7, 1.8 million homes a year. That's 1.2, 1.25 million households, and we could see a period of much stronger household formation growth because a lot of 20-somethings couldn't get work. They doubled up with their parents, and I would consider that to be a pent-up household that will get formed at some point. 350K in obsolescence, so Hurricane Sandy blows through, wipes out 250,000 homes. That has to get rebuilt. That happens every year, and it's just normal obsolescence. And second vacation homes. High-income households are doing very well. The largest group of the population is in their 50s, and so a lot of second vacation homes. You add it all up, it's 1.7, 1.8 million units. So you go from 950K to 1.7, 1.8 million over the next few years. That's a boatload of economic activity and a lot of jobs. Every single-family home that's constructed produces about 4 jobs over a period of a year. So just do a little bit of arithmetic. That's a lot of jobs, and gets you pretty close back to full employment. Now, the threat to this part of the story is obviously interest rates. Housing is very rate sensitive, as we've seen in the last couple of months. The rate surge that we saw since the beginning of the year has done some damage. And my baseline view is, my optimistic view is that the Federal Reserve will be able to manage interest rates, mortgage rates, higher over the next several years, consistent with the improvement in the job market. So as the job market improves, we get more jobs, unemployment rate falls, that interest rates will rise, the better job market will trump the effect of higher interest rates, and we get this positive script. Obviously, there's a lot of risk there. We can see that by the Fed's actions recently. They, in my view, made an error in policy in their decision not to begin tapering QE. Not because the economy, not taper, I can see the arguments for not wanting to taper QE given what's going on in the economy and given the fiscal threats. I understand that. But they didn't guide expectations in the marketplace. They shocked the marketplace, and I think that undermines their ability to communicate with the marketplace in the future. And that's a big problem for them because their most powerful tool for managing long-term interest rates going forward is forward guidance. And that depends critically on their ability to communicate with the market. And I think they did some long-term damage to their ability to do that. But nonetheless, I remain optimistic, and I think they'll be able to land the plane roughly on the tarmac. Finally, the third reason for optimism is a more fundamental one, and that is, I think, the private economy, that's non-financial businesses, corporations, banks, the financial system more broadly, and households are in very good financial shape. They've done a marvelous job of reducing, businesses have done a marvelous job of reducing their cost structures. They're highly competitive. Unit labor costs today are about where they were. Unit labor costs for compensation per unit of output, so you're accounting for productivity. They're about where they were 5-10 years ago. In manufacturing, they're about where they were 20-25 years ago. So American companies are very competitive, and you throw in the energy story, and it makes it even a more compelling kind of picture. The banking system is overcapitalized in my mind, 9% plus Tier 1 capital ratios, and they're going north, and that's record highs and rising. Ample liquidity, credit quality is improving incredibly rapidly. You could argue, except for first mortgages, credit quality is about as good as it's ever been in the data that we see. And households, we do need to make a distinction between lower income households, middle income households, and upper income households. Those folks in the top part of the distribution are doing fabulously well. If they have any debt at all, it's a 30-year fixed rate loan. They locked in, they refied down, they've locked in at 5%, something like that. They're sitting they may have an auto loan, but only because it's free money. I have an auto loan at 2%. Why wouldn't I take a 2% loan? And their balance sheets are very strong. So we have to make a distinction but lower income households aren't doing quite as well. But if you take the household sector in aggregate, it looks very good. The household debt service burden, the proportion of after-tax income that households have to devote to servicing their debt to remain current on that debt is as low as it's ever been in the data that we have back to 1980. This is Federal Reserve data. So I would argue that the private economy is sitting pretty. Its balance sheet is beautiful, and it will shine through as the fiscal drag fades. The threat to that optimism, though, and this is where I'll end, because I am an economist and I can't end on a high note, is we need a field of dreams moment, as I would call it. All the preconditions for risk-taking are in place. The balance sheets, the income statement, the cost structure, the profitability, everything you would normally need to have business people, households, investors to take real risk are in place. But yet they remain incredibly cautious. Businesses just aren't pulling the trigger on those field of dreams. And we get it, this happens every business cycle. You go into recession, you get into recovery. At some point in the recovery, businesses switch from trying to reduce costs and focusing on revenue growth and looking for growth opportunities, and they take a chance. They build a new plant, start a new product line, enter into a new market. They don't know if the business is actually going to be there to support the investments they're making, but it's a leap of faith. It's a leap of faith. And usually it's one CEO in each industry that takes the leap, and then every other CEO follows because nobody wants to lose market share. We just haven't had that field of dreams moment, and I'm not precisely sure what the catalyst will be. I feel confident that if Washington can kind of nail things down in the next few weeks, that we'll get that field of dreams moment, but there's the risk. Thank you.
All right, Stephen.
Okay. Well, 3 bulls in a row should probably make you feel a little bit nervous, but I concur a great deal right here in terms of the outlook for the world economy and the U.S. economy. I think it's rather remarkable that the U.S. economy has been able to grow close to 2% in the first half of the year with combined tax increases and spending cuts that represent the fiscal tightening as severe as sort of the wind down of the Vietnam era. So our ability to grow through that hasn't been seen in the past. I think we should all understand that there were many cause and effect reasons for a slow period of growth after a horrendous credit crisis in the 08-09 timeframe. This has been predicted, but clearly these periods don't last forever. And a lot of the drags that occurred in the economy, housing continuing to unwind in the U.S. economy deep into the recovery, fiscal drag up until the early part of this year, and a great deal of balance sheet adjustment. Tremendous changes in the financial system, but the real economy as well. As we already heard from Mark, consumer debt burdens having the largest decline that we could ever see in the data in a period where labor markets really haven't tightened that substantially yet. These are reasons why the Federal Reserve would forecast growth of close to 3% in the coming year. So here we are, and I think it's pretty clear to see that financial markets have accelerated, and I think we will see the real economy globally accelerate too, but there'll be pretty big differences, as Bruce had noted, across different regions and countries. And that has to do a lot with the setting and what has happened over the decade prior. So I'll focus a little bit on of the longer term setup for where we are right now. I've spent the last 17 years visiting clients around the world for Citigroup, and in the last 10, or at least up until 2011, 2012, you could really see the desire for capital, both inside the U.S. economy and outside the U.S. economy, to move away from dollar-based assets, to move into emerging markets, to move into commodities investment. And we have seen since 2011 some reversal in those trends. I think it's two things. We had a very commodity-intensive type of growth in China, with it seeming for a long time that China would just buy commodities from the rest of the world at an ever higher price. And that was sort of the growth and nature of their development for a long period of time. I think that's changing a bit going forward. But very importantly, what's happened in oil markets, and there are just tons of derivative impact around the world that I think is very notable and is going to have effects on how economies come out of this globally going forward. So if you looked at the long history of oil and some other industrial commodities, being a commodity was essentially kind of a negative connotation to that world. You were easily replicatable, you could always be produced. And up until, let's say, 2002, for a long period, whenever there was a spike up in the oil price, the distant futures price for crude oil and a few other commodities didn't move very much. When the first Persian Gulf War happened, there was a spike up in oil, but everyone in the producer world assumed, well, we could just pump some more oil. So there was never the profit opportunity to really expand and sell forward your future production. Come 2002, that changed. And in 2003, the U.S. invaded Iraq. We started to see distant futures prices for oil go up routinely with the spot price. And so for most of a decade, just interrupted for a time, during the global financial crisis, in 08 in particular, there were some pretty severe disruptions. You would see the profitability of the energy sector and commodity-intensive sectors move up very sharply, and investment followed. And lots of countries around the world that were exposed to that had tremendous fiscal improvements. Their economies improved, their incomes rose solely with price change, not with real economic growth. We saw tremendous declines in borrowing costs across the EM world. Countries like Brazil ended up with tight labor markets and got there to a really dramatic amount of improvement in their economy and development with this commodity supercycle. Well, over that 10-year period of time, interesting things were happening inside the U.S. economy, away from the global financial crisis, away from some of the real cyclical and episodic things. Investment in the energy sector in the U.S. economy quadrupled relative to GDP, from a low level to a still low level, but it tremendously outperformed. And with the technology to produce more gas and oil in the United States, we've had a dramatic shift. And that is the futures price for energy is now well below the spot price. There are a variety of disruptions going on in the world. There are some very severe political risks in the Middle East. There are, in fact, sanctions against oil-producing countries, and yet the crude oil price is well below where it was at the beginning of 2008. Now, over that time, that 10-year period up until 2011, the US dollar fell in 8 out of 10 years. And we saw dramatic portfolio flows, as I mentioned, into the emerging world, making growth quite easy to achieve by historical context. So now, in this period where commodity prices are not simply going up all the time, where U.S. Growth expectations have moved up and real interest rates have risen from May on, we started to see turmoil in various emerging markets where countries have moved from surplus to external deficits. Some of these countries have no external debt. We can't always say why exactly these countries are being hit. But I would just say that currency market turmoil in the emerging world is a lot more frequent than global financial crises in the banking sector in the developed world. So like we've seen with this episodic rise in interest rates, which we think will have further to go in coming years, it will be contained, we think. We don't see a Greek-style sell-off in the U.S. Treasury market with the fundamentals that we have in front of us. But there will be periods where this very profound easing cycle by the Federal Reserve will have disruptive effects in markets. Like Mark said, I think that the Fed, we can say a lot about policy, and our egos about whether we predicted it right or not earlier this week don't really matter very much. But the ability to communicate and get consensus here on policy going forward is very important. The Fed didn't walk through an open door in markets to show that quantitative easing would not be endless. And next time, when they really want to make a change in policy, I think it'll be harder to get consensus in markets. It may end up being a bit more disruptive in markets when they want to change policy. So I don't want to end on doom and gloom. Again, I do think that we have a stronger global economy coming. We have seen purchasing managers' reports in the biggest economies in the world, Europe, Japan, China, and the United States, accelerate for 2 months. In some cases, I think we don't have all of the demand confirmation that we would like to see that that's sustainable. But a lot of the drags on the global economy are coming off, and that will benefit many of the emerging markets that are well positioned for improvement in trade. Unfortunately, it will leave some behind. I'll stop there.
Thank you very much. Just to pick up on a couple of things that have been said, I wonder if you could, you collectively, could comment. Every time the unemployment number comes out, there's commentary about the unemployed. How the labor force is shrinking, and which obviously, distorts the numbers to some extent. Can you go ahead and comment on that?
So the participation rate in the U.S. today stands about where it did in 1978, and that's with some demographic and secular changes over that period that actually lifted participation rates of women and lifted participation rates of older workers in the workforce. So we've had a fairly dramatic decline. I think there's an understanding that the aging of the baby boomers to positions where they spend less time working is demographically slowing it, but there's been a drop here which is very hard to explain just by that alone. The issue there is that we have to decide as we move forward here how much of the economy's capacity to grow is being altered by this, and the Fed is grappling with that issue quite actively right now. I think the good news is that we are generating jobs. The last 12 months we've generated jobs at 180,000 a month pace, which is pretty good, especially given the GDP at less than 2% over the last 4 quarters. But the concern here is that if this is a structural event, if it is an event that's telling us that people have left the workforce permanently, then the capacity to grow going forward is limited. And I think this gets to the issue of, if we are right, and I think it's every reason to be cautious if you have 3 economists together telling you the U.S. economy is going to do better, how much can we run this? We need to run this quite strong for quite long to get a labor market where the utilization, where the number of people working as a share of the population is back to what we thought was acceptable before. And if the exit of people from the workforce is permanent, we're going to hit tighter conditions. We're going to hit wage and inflation pressures earlier on. It's still somewhat of an academic issue, but it's not academic from the point of view of the way the Fed is guiding us on policy and the way the Fed is making decisions on things like tapering. The decision on tapering this week was a surprise, partly because the Fed was starting to express somewhat greater concern about the unemployment rate, and in fact, at the June meeting, described its path as wanting to get through the tapering process and end QE by the time the unemployment rate reached 7%. And the unemployment rate went down 0.3 since that time, they backed away from tapering. And what they did yesterday was, Wednesday, was actually back away from that message about the unemployment rate. So there's along the lines of what both Mark and Steve was saying, there's a little bit of inconsistency in communication. But this is a huge issue for not the economy's performance over the next 2 or 3 quarters, but the economy's performance over the next 3 to 5 years, because it tells us something about the speed limits and the capacity that we have to be able to grow, and what's the end point in which we find ourselves in.
Can I make just a quick follow-up on the labor force? Sorry that I haven't checked the very latest data, so you can correct me, but what's been really surprising about the drop in labor force participation, and the labor force is growing a bit. It's just not growing rapidly, and as much as employment is actually growing. But it's been remarkable that it is not the aging demographic. It is not the 75-plus population, the 65-plus population that is failing to participate. You see fairly rapid growth rates of employment for that cohort, where you've seen a really horrible performance in the labor markets going back 5 years, people in their 30s and 40s. And I think we're still in the
20s and
That's
teens.
really,
Yes.
it's really in your
Again,
20s.
the
Yeah.
teenage labor force, I will say, that probably won't suffer long-term damage if they don't get a chance to work before too long, if they live with their parents. But literally mid-cycle, mid-career people who usually have the sharpest increase in income and in experience, have seen very little progress in employment, and very slow labor force participation, outright declines over the course of 5, 6 years. I would hope that that is a source for optimism, that there really is no recourse but returning to the workforce. I hope these are the people that have stuffed our community colleges full, looking for some retraining and the opportunity to come back to the labor force. And if so, I think that we do get that. We will get a stronger sustained rate of growth without dropping down our capacity to grow. But I think that's a really interesting twist on this when people say that this is entirely demographic and about the obvious problem we have with aging.
Do you want a third perspective, or you want to move?
Quickly, sure.
No, we can
Then I
move
have a
on.
question.
Yeah, you're already bored, I can tell.
I'm not bored at all. I never get bored. Too much interest.
Well, from my perspective, the participation rate is down 2.5 percentage points roughly since the recession hit. Of that, 1.5 percentage points is demographic. It's the aging of the population, and you can, pretty straightforward calculation, you could figure that out. So that means, roughly speaking, 1 percentage point is due to the bad economy, people stepping out. And it's actually consistent with other data. If you look at, there's a question in the household survey that asks people who have stepped out of the workforce, would you take a job if one presented itself to you? And that's up about 1.5 million people from where it was prior to the recession. That equals 1 percentage point on the unemployment rate. So I think Bruce is absolutely right. There's a lot of debate, reasonable debate about this. But I think a good rule of thumb is that about a percentage point of the decline in participation is cyclical, and we've got to absorb that before we can conclude that we're back to full employment when the unemployment rate is between 5.5% and 6%.
Let me switch subjects to that of fiscal deficits in the U.S. and Europe. They were a subject of great concern when we hit the wall, so to speak. There's less talk about it now. How do you see those working their way through it? Go ahead, Mark. Why don't you go?
I think the policymakers, the collective we, achieved the very minimum we need to do over the next 5 to 10 years. That is, if you go back to 2011, the start of 2011, when fiscal austerity began, and believe it or not, we've been engaged in various spending cuts and tax increases since early 2011, and you look at current law and take it out under reasonable economic assumptions, and they're reasonable because they're my economic assumptions, so they're reasonable.
Makes them reasonable.
Yeah. We cut about $4 trillion out of future deficits. That means that the deficit will decline into 2015, 2016. It'll bottom out at about 2.5% of GDP, which is sufficiently low to stabilize the nation's debt to GDP ratio between 70 and 75%. That is the bare minimum we needed to do to avoid a near-term economic problem. We accomplished that. Therefore, in my view, it would be more important to not have these kinds of fiscal battles and debates and take it to the wall kind of discussions, because it's very counterproductive to confidence and to that field of dream moment that we need. We really want to get Washington off the front pages if we can, and if we can, the private economy and the good private economy will shine through. And then when we get down the road into the second half of the decade, we do have to worry about the fiscal problems in the 2020s and the 2030s because, again, under reasonable economic assumptions, under current law, we got a big problem with Medicare and Medicaid because of the rise in entitlements.
Entitlements
Right, and so we need to address that, but we don't need to address that literally today. And in fact, this may sound counterintuitive, I'm almost arguing that let's not even worry about it today so we can get going here. Because if we try to battle this one out, we're not going to solve this problem, and all we're going to do is create uncertainty and impair the ability of the economy to fully engage.
Anyone want to add something
You
to
want to
that?
follow on outside the United States?
Yes, outside the
Just, you know, a couple developments.
Europe in particular, yeah.
Yeah, sure. Well, we'll start with Europe. I mean, what's quite interesting here is that if you look back at the crisis moments, the U.S. budget deficit, I think, peaked at 1.4 trillion, but we collect twice the share of tax revenues directly from employment and income as Europe does. Europe has these non-cyclical sources of revenue, the VAT, et cetera, and so they didn't have quite the swing, but they have these longer-lasting fiscal problems. You know, and there are huge differences across these countries, of course, but just the general question of debt sustainability has not been fully answered in Europe. In a country like Italy has higher interest rates than Germany by far, yet has slower nominal GDP growth, not very large budget deficits, but you still have the issue of can growth overcome debt sustainability problems in the periphery of Europe. And so it's not so much cyclical, it's the question of do you have strong enough trend growth to support social benefits? In the case of Japan, another interesting story where they've really had this Volcker moment where they're running monetary policy completely different than they have in the past, and we're quite optimistic, even if a part of that is really essentially taking trade share back from others, more of in a zero-sum way. But at the same time, have fiscal tightening ahead in current law. And the last time they raised the consumption tax in Japan, it was 1997. The economy of Japan entered a recession somewhat before the Asian financial crisis hit and seems to have exacerbated that problem. Now, that tax increase was never repealed, to my knowledge, and yet you still have this massive rise in debt to GDP in Japan, even with fiscal tightening. So it worries me that they're talking about fiscal easing to offset their fiscal tightening when they should maybe just say, let's just go for growth and work out our fiscal problems in the longer run.
Bruce, is there any risk of the monetary union in Europe, anyone having to exit? Has that been lowered so it's not an issue anymore?
I'd say two things about it. First of all, I think it has been lowered quite dramatically, and I would kind of take a little bit different point of view on the debt issue. I think sustainability of debt positions in Europe, particularly on the countries that have been under stress, is no longer a significant issue in a world in which we have effectively shared credit risk with the imposition of the OMT program and some other firewalls. The distribution of the burden going forward is a huge issue. Are we going to actually ask the Italians to get their debt levels cut in half, which is what the Maastricht Treaty would expect? Are we going to actually ask more of the Greeks, which would be what the path that they're needing to follow? And I think this becomes, I think, the big issue on Europe going forward. We've put in place firewalls partly by sharing credit risk. We've not decided the burden of the legacy problems that were created over the space of a long period of time, how they're going to work themselves out. To the extent that those firewalls are in place, I don't want to tell you that we couldn't see a country like Greece have politics turn decidedly negative and have it choose to leave monetary union sometime over the next couple of years. What I want to tell you is I don't think it matters from the point of view of the union itself. And what I want to say is that I think ultimately whether monetary union is going to survive or not is about the political commitment to a shared vision of political institutions going forward in 4 countries, Germany, France, Italy, and Spain. And monetary union will not be broken up by near-term financial and economic developments, but it still remains to be seen whether the French and Germans in particular can come to a common agreement and vision about the future. And right now, there isn't that in place. And I think it's quite striking how the Germans, I think, have a vision about where monetary union goes, and the French have an incoherent vision about where monetary union goes. And until you can align that, I don't think you can be completely comfortable that over a long period of time, this experiment couldn't fail. But I think we've done a lot here to take out the risks, and certainly have taken out the risks of a small country spilling over stress in a way that the system is a threat.
And Stephen, just a non-economic but a political question, what about the UK leaving the EU?
Oh, boy. That's,
Is that a risk?
well,
Or maybe they'd say an opportunity, I'm not sure.
yeah, I think it depends on who you ask in the UK, and then you have to consider, you know, all the ramifications, you know, for those who benefit as well as those who don't. That's a very difficult question for me to answer on the UK, and I think our answer is that they will not leave the European Union, but that other things that are proposed in the European Union that, you know, on certain politicians' wish lists don't also come to pass either.
That's true.
Could I say one thing on that?
Yeah, go ahead.
I just want to say that I think if you take the logical consequences of success and integration at the monetary union level, it's going to make it increasingly untenable for the UK to stay in the European Union. And I think the two paths there are coming into conflict.